As the World Cup puts a spotlight on the global stage, investors may want to look beyond the U.S. and abroad for their next investment opportunity. Let's discuss that with Malcolm Dorson. He is the Senior Portfolio Manager for Emerging Markets here at Global X. Malcolm, it's great to have you.
Thanks for having me, Seana.
So here we are 6 months into the year, the halftime report. We're sticking with the World Cup analogy here. Where do things stand?
Sure. Well, coming into the half, emerging markets has established a commanding lead. Looking at year-to-date numbers, emerging markets are up roughly 24% versus about 8% for the S&P. Taking it a step back, looking at 12-month numbers a little longer, emerging markets are outperforming by roughly 24%. And on a 2-year basis, emerging markets are outperforming by roughly 30% compared to the S&P.
So let's talk about some of that outperformance and then where those opportunities are, the game plan, as we think about investors outlining or figuring out what makes the most sense for their portfolio. If they're looking at emerging markets, what sets EM apart from some of those other opportunities, the driving forces?
Absolutely. Driving forces, let's think of three. Let's think of valuations, let's think of the US dollar, and let's think about positioning. And everyone's asking, do I have enough emerging markets exposure? Because they're looking for complements or different parts of their asset allocations to begin to differentiate themselves and do something differently that they've done over the past 5 to 10 years. So looking at things from a valuation perspective, emerging markets are now trading at a 42.5% discount to the S&P, despite converging levels of EPS growth. That stands out. From a dollar perspective, we're coming out of a 10-plus year period of a strong US dollar environment. Things are changing. There are a lot of question marks about the direction of US monetary policy. Both sides of the aisle in terms of the US seem to have their foot on the gas in terms of spending and driving a larger fiscal deficit. And in terms of looking at growth domestically versus internationally, there are many large international countries that are showing higher GDP growth levels than the United States. So I'm not here to forecast the direction of the dollar, but looking at similar patterns in the past, this has translated into weaker US dollar environments. And when you have a weaker US dollar environment, emerging market equities stand out. When the DXY weakens by roughly 1% over the past various cycles, emerging market equities have rallied about 3.5%. My last point is positioning. The MSCI All Country World Index recommends roughly 12.7% exposure to emerging market equities. Most clients that we speak to have roughly 2 to 5% exposure. So just to get equal weight, just to sort of cover your tail, not necessarily going overweight or bullish, you have to double or triple your exposure in many cases. That can be really meaningful for flows.
It certainly can. So Malcolm, for investors that are looking to really increase their exposure, of course, the question is, what country makes the most sense? Where is the best opportunity? Talk to me a little bit about the lineup that you walk through in your mid-year outlook, and then positioning maybe the top countries or top plays that you see at this point in the year.
From a lineup perspective, we tried to find different markets and fit them into different positions. So strikers, markets with high upsides, near-term catalysts, strong momentum, areas where you can really score. Midfielders, we're looking for some more versatile opportunities, so strong quality compounders with upside potential from structural growth opportunities, but also areas that give you some defensive qualities as well. And then speaking of defense, here we're looking for income, we're looking for low volatility, and we are looking for areas that can diversify your portfolio. So what sticks out in terms of our top 3 picks? We're focusing on offense. So looking at strikers, Argentina really stood out. Argentina is checking boxes in terms of growth, in terms of valuation, in terms of momentum. You have a strong, prudent, fiscally orthodox government delivering in terms of lower inflation, higher growth, and really unlocking the valuation opportunities and commodity opportunities across that economy. We also see a really interesting catalyst in terms of potential MSCI inclusion over the next couple of years that could bring billions of dollars into Argentina. Moving over to midfield, we think emerging markets ex-China really stands out. This is your center midfielder, your number 10, signed at our captain's spot. And we think that this is interesting because it offers you the technology trade in Korea and Taiwan. It offers you political reform and commodity exposure in South America. It offers you structural growth opportunities in India and Southeast Asia, all without any direct exposure to China. The third opportunity that I want to point out is India. Now, India, for the first time in a very, very long time, now trades at a discount to its historical average from a valuation perspective. At the same time, it's still clipping GDP growth above 7% per year. It still has a fantastic level of governance from a government perspective, delivering positive market reforms, fiscal orthodoxy, and strong stimulus for growth. And the last point about India is that we see some near-term catalysts. So if energy prices come down, India is a major importer of energy. That could be a very strong driver of growth for the country. And then the second part is a potential U.S. free trade agreement within the next couple of months.
Clearly a lot of reasons to be optimistic about the opportunities right now within emerging markets. I'm curious, so from an investor standpoint, as they're looking to strategize their portfolio allocation, how should they be thinking about this? Is this a single game, a single season, potential dynasty when it comes to some of those longer term structural shifts? What makes the most sense, or how are you viewing it?
Yeah, it's a greid question because in an outlook, mid-year, annual, you're thinking 6 to 12 months and you're going back on that and checking the scoreboard. But take a step back and look at what's happening in emerging markets. These are long-term structural reforms. Commodities aren't a cyclical trade anymore. They're a structural opportunity. These new governments are making responsible decisions. You're seeing autonomy from central banks. And overall, I think we're seeing a lot of similarities to what we saw in the early aughts when emerging markets are up over 340% between 2001 and 2010 compared to roughly 15% for the S&P. So look at it from a perspective of positioning, valuations, direction of the US dollar, and emerging markets might be positioned for a very strong longer term cycle.
For investors to evaluate here. Malcolm, great stuff. Thank you.